Gold and silver are falling. For many people, that sentence feels wrong, because gold and silver were never explained as normal assets. They were explained as protection. They were described as the final layer of safety, something solid when everything else feels uncertain. So when their prices fall, it creates a quiet discomfort. Not panic, just confusion. The kind of confusion that makes people keep checking charts, hoping they misread something. Here on the moon, the aliens are quiet. They're not reacting emotionally, they're just watching. Gold and silver were never designed to grow. They don't innovate, they don't create companies, they don't solve problems. Their role is much simpler than that. They exist to store value, not increase it, just preserve it. Gold doesn't compete, it doesn't rush, it doesn't try to convince anyone of anything. It waits. That's why gold behaves differently from almost every other asset humans interact with. It responds less to logic and more to belief. When inflation rises, people expect gold to rise. When governments print money, people expect gold to rise. When debt grows larger than anyone wants to admit, people expect gold to rise. And on paper, that makes sense. But markets don't move on paper. They move on behavior. On what people choose first. And right now, people are choosing something else. One of the most overlooked reasons gold falls is the strength of the US dollar. When the dollar strengthens, it pulls capital toward itself. Not because it's perfect, but because it feels temporarily stable. Money flows toward what feels strong now, and away from what feels patient. Gold doesn't resist this. It steps aside. This isn't failure. It's sequencing. Gold does not pay interest. Silver does not pay interest. When interest rates are low, this doesn't matter. But when interest rates rise, something changes in human behavior. Suddenly, money can make money again. Savings accounts pay, bonds pay, treasuries pay. And humans are drawn to reward. Not because they're greedy, but because certainty feels comforting. Gold doesn't offer certainty, it offers protection. Those are not the same thing. When people sell gold during high interest rate periods, it creates a dangerous misunderstanding. It looks like rejection, but it isn't. It's postponement. Gold isn't being abandoned, it's being sidelined, waiting for a moment when yield no longer feels safe. Gold does not rise when people worry. This is one of the hardest truths to accept. Gold rises when people give up, when confidence leaves quietly, when people stop asking when things will recover and start asking what still holds value. Right now, fear is present, but belief still exists. And as long as belief exists, gold stays patient. Most gold trading today does not involve gold. It involves promises, contracts, screens, numbers moving faster than reality. Paper gold can be sold instantly. Physical gold cannot. So when traders exit paper positions, prices fall, even if physical demand hasn't changed much at all. This creates confusion, because the price reflects behavior, not reality. Silver behaves differently from gold, because silver lives in two worlds. It is money, and it is industrial material. When growth slows, silver feels it twice. Less demand, less optimism. Less patience, so silver falls harder. And faster. This doesn't make it weak, it makes it sensitive. This moment does not mean gold has failed. It does not mean silver is finished. It means markets are still choosing productivity over protection, yield over patience, hope over acceptance. That choice never lasts forever. It never has. Gold does not panic. It does not predict. It does not explain itself. It waits. And history shows that when belief finally breaks, gold is usually still there, exactly where it always was.